In Module 5.6, we're going to take a quick look at solving for implied option parameters. Probably the most common parameter solved for is implied volatility, but there's no reason to limit ourselves to just that particular implied parameter. And there are cases when we need to solve for other implieds. And so we're going to introduce a method to solve for implied parameters within the GBM OVM. We'll illustrate that with ARD code snippets and explore equity as a call option on the firm, which is a very popular way to deploy an option market within equity valuation. The central finance concepts, we typically set an upper and lower bound on these parameters. We'll compute the option implied parameters. It often requires a maximum and a minimum. There are two ways to go about this. One, you can let the user define what these upper and lower bounds are, or you can hard code it. And the other thing that typically gets coded in is the tolerance level. Generally, you're trying to find an optimum or some optimization approach, and you have a tolerance level that is essentially hard-coded as my recommendation, as the end user doesn't really need to concern themselves with this particular challenge. And so we will examine implied volatility, which is familiar to some. We'll explore implied stock price. And you think to yourself, well, why would I want to solve for the implied stock price? I have it. Well, there are times when you don't have it. If you think of equity as a call option on the firm, the underlying is the firm value, which you don't have, and the volatility is the firm volatility. And so there's some interesting things you can do if you're able to solve for the implied stock price, and you can basically solve for the remaining parameters and make them implied, assuming you have the rest. And so if you recall, the GBM OBM model, the dividend adjusted model, can be written in this fashion. Typically, we have the 6 inputs: the stock price, dividend yield, strike price, time to maturity, volatility. And we solve for the model prices, but actually in practice we have the market prices. And so the way this works is we have the call and put market prices, we have the other remaining parameters, and we solve for the implied volatility of the model. And so IVM is the implied volatility of the model. Clearly, if we use different models, we'll get different implied volatilities. And therefore, it's important to know when you're receiving implied volatility information, it's important to know which model was used in generating that particular implied number. And so historically, there's a whole host of different ways to estimate and approximate the implied volatility of the model. Brennan and Subramaniam had one, and a variety of other people had these approximation techniques. I actually had a nuclear physicist take my classes years ago, and he came up with a fairly accurate technique. But as computer power has gotten so much more powerful, there's just really no need to try to approximate this when I can get it accurately using a search routine. And so the main takeaway from this table is that these implied volatility estimates should be 30, and they're not. And they're not even close to 30. At times they're fairly close, but not close enough. If I'm trying to really optimize my search routine, I might start out with one of these estimation techniques in order to get close, and then solve for the exact answer. It'll solve a little faster. This is a graph generated by a colleague of mine, and he actually has a package. It was Robert McDonald at Northwestern has an R package that was available at one time that could read off of option metrics, and this is basically what's known as the volatility smile, with different strike prices on Apple on this particular day. We have different maturities, and we have different levels of the smile. If the model was a correct reflection of the market, then we would expect these lines, we would expect the lines to differ, but we'd expect them to be flat. And so the fact that there's a persistent smile or smirk, depending on which, whether the left-hand side or right-hand side is steeper, informs us that the model we're using doesn't accurately reflect the implied, the volatility of the underlying instrument. For example, this 8-day option, well, there should only be one volatility for all the strike prices for an 8-day maturity. But there's a variety of different volatilities, and therefore that implies that the underlying distribution that we assume is inaccurate. So the assumption of the log normal is inaccurate. We can solve for these implied parameters. We introduced this approach with in chapter 3, solving for implied parameters, and basically we have a test routine that will check whether there's a difference between the input option value and the model value given a certain implied. We'll optimize this function, and it will solve for the volatility that gets me the market price back. There's a variety of different ways you can optimize this. I took the square. If you just comment this squared part out, you can take the absolute value, and it converges to similar numbers. So a simple example: $100 stock, $100 strike, interest rate of 5%, time to maturity of 1 year, implied volatility of 30%. Using a 1423 price, I know that the volatility that gets me that price is 30%. And what the model kicks back out is 29.99999, which is close enough. And again, it's an iterative search routine, and therefore it quits once it gets to a close enough number. Once I calculate the implied volatility, I use that number in the input data to get the call price, and that gets me the input number back. We could solve for the implied stock price. Given the option market prices, we could solve for the implied stock price. You could think of equity as a call option on the firm. So FV denotes firm value, T is duration of the firm debt. We're going to translate all the indebtedness of the company into a zero coupon maturity bond with T years to maturity. DPV is the debt par value equivalent to the strike price. This would be the par value of the debt at that maturity. Volatility is the volatility of the firm assets, and we could solve for the firm value. And so the modified GBM OVM model would look something like this. And basically, given these parameters, what is the firm value? The equity value, remember, is the call option. Well, these parameters were selected in order to get a firm value of $200. And so if the equity is worth 100, the firm is worth 200, we have a debt to equity of 50%. And depending on firm volatility, you can look at the behavior of the firm value. As firm volatility goes up, we see the firm value actually declines. We could solve for the implied strike price if we wanted to. We could solve for the implied interest rate of the model in this particular case. The implied dividend yield. The implied interest rate is there's sort of a academic question here, and what is the right base curve to use to value options? Well, historically, LIBOR-based curves function very well. But now that LIBOR has been terminated by regulators, then it's an open question on what discount rate, if the SOFR-based swap curve or some other curve will reflect option prices better, is an interesting academic question. We can solve for the implied dividend yield. Given many other if we have the market option prices as well as the other parameters, we could solve for the implied dividend yield and ask whether or not that seems reasonable in light of what our expertise in modeling dividends say. We could solve for implied time to maturity. Now, this raises an interesting question because the put price is not monotonically increasing in time to maturity. And because of that, you can get two different answers. And so if you plug in the normal canonical example that we used before, you would expect the implied time put time to maturity to be 1 year, but here it's 20.29 years. And in fact, using that time to maturity gives me the inputted option price, put price. And well, why is that? Well, the further I go out, the present value effect of the maximum payout of the strike is declining. And so there's actually two solutions to this problem. The way to handle this is to set the upper bound lower. And in this case, it gets the optimum solution is 1 year. So there are two solutions for puts if we don't constrain the search window. We'll end up with two different solutions. So in summary, we introduced a method to solve for implied parameters within the GBM OBM. There is R code that was provided with this particular module. I'd encourage you to play around with it and explore it and make sure you understand how to solve for these implied parameters. One useful parameter to solve for is implied firm value when we're modeling equity as a call option on the firm. And in credit analysis, there's an enormous amount you can do with this particular insight. It led to something known as the KMV model. And so with the understanding of these quantitative finance concepts combined with the ability to code in R is going to open numerous doors for you as a quantitative analyst.